What do Jay-Z and Bill Ackman have in common? SPACs. We see SPACs all over the news, and they seem to have become popular the last couple of years. So, what are SPACs? Before we get into what SPACs are, I'm going to do a little portfolio update. We saw Bitcoin hit the 60K area over the weekend, and that allowed me to be up around 5.59% for the day, and 64.09% overall in unrealized gains. As for Ethereum, we are still not back at the $2,000 level, but we had a 7% up day. I'm currently back above 200% in unrealized gains, so that's pretty good. As for Litecoin, I'm up 43.87% in unrealized gains, and this is why we don't sell during the dip unless it's the month of September. The last Bitcoin dip saw Bitcoin retract around 26% and it lasted for a whole week. I'm pretty sure there were people calling the top throughout the week. However, if you dollar cost average during the dip, then you're already up 40.83%. Someone tell me an investment that can have that rate of return in such a short amount of time. Anyways, remember to press the like, subscribe, and notification bell as it really helps my channel. Now, let's get into what SPACs are and whether they are even worth it. SPACs stand for Special Purpose Acquisition Company. This company does not make or sell anything. Instead, when they IPO, they try to rake in the most money they can get. Using the money they have just raised, they will start to invest or acquire certain companies. However, when the SPAC is created, the founders do not disclose which companies they are going to invest in. They don't want to disclose the companies they are interested in because that would involve more paperwork. Therefore, SPACs are also called blank check companies, as investors are just giving their money without really knowing where the money is going to be invested in. At this point, it may sound like SPACs are only good for the owners of the SPACs, while the investors don't have a lot of benefits. I mean, at this point, they're just handing money over to some well-known investor or hedge fund manager who doesn't even tell them where the money is going to be spent on. However, there are some advantages for investors. A SPAC has generally 2 years to complete some sort of deal or else they'll be liquidated. Until then, they keep their money in an interest-bearing trust account. There are other advantages, but most of them apply to the small business owners who have private equity funds available. When a small business owner sells a portion of their business to a SPAC, the sale price is increased up to 20%, which is a lot more than a straightforward private equity transaction. Furthermore, SPACs provide the small business owners different business opportunities, as SPACs are generally managed by respected Wall Streeters who have connections within the sector. However, for everyday retail traders like us, it's pretty hard to invest in SPACs before they IPO. I mean, there are a few SPACs out there for everyday traders like us, but if they're available to retail investors, then they probably didn't do so well raising money from higher net worth individuals. Therefore, the safest way to invest in SPACs is after they IPO, as they are usually listed on major exchanges. However, even if people were able to invest in SPACs before they IPO, SPACs on average have a lower return on investment at only 8% when compared to the traditional IPOs returning a 28% investment. With that short synopsis out of the way, why did we see a boom in SPACs recently when they have been around for a very long time? Back in late 2018 and early 2019, we saw the government shut down. This government shutdown was the largest in United States history. It lasted from December 22, 2018 to January 25, 2019. The shutdown occurred due to Congress and Trump not agreeing on a bill that funded the federal government for the year of 2019. Since an agreement was not made, the Anti-Deficiency Act was enacted. The Anti-Deficiency Act states that federal agencies are not able to conduct non-essential businesses without funding granted to them. This act shut down many agencies, including the SEC. During the shutdown, the SEC was not able to review SPACs IPO registration with the same level of stringency. In this small duration, we saw SPACs IPO without any SEC approval. During the shutdown, the SEC allowed SPACs to IPO as long as they announced their IPO price 20 days before IPOing. This caused a bunch of SPACs to IPO. Today, we see SPACs all over the news, even with celebrities endorsing them. For instance, we saw Jay-Z become the chief visionary officer for the parent company. This SPAC combined Roc Nation, Caliva, and Left Coast Ventures and formed the largest cannabis SPAC. As celebrities are getting more involved with SPACs, we saw the SEC put out a warning that SPACs may not hold the same interest as the investors. Now, let's look at some SPACs that failed. AVCT is a blank check company that was founded on April 7, 2016. This SPAC eventually IPO'd on August 1, 2017 with 27 million units valued at $10. This spec had the goal to integrate all branches of software development, from developing the software itself all the way to licensing the software. It was basically trying to have all components of software development under one umbrella. One of AVCT's major purchases they made most recently is Candy Communications. Candy Communications is a cloud-based communication company. Candy Communication provides tools that allow their customers to create and manage their applications. Furthermore, they're involved in customer service and have services that allow app developers to communicate directly with their customers. However, things didn't turn out very well. After AVCT IPO'd, it went on a downward spiral until it finally hit 42 cents on April 24, 2020. To be fair, this was during the height of the COVID pandemic. In their 10K filing, there is a whole section where they explained how the coronavirus was taking a big hit on the company. However, even before the pandemic, we saw AVCT trade way lower than its initial offering of $10. Furthermore, we saw other traditional tech companies prosper during the pandemic. This led to many rumors that the management team behind AVCT was poorly managed. Instead of focusing on acquiring tech companies that would strive during the pandemic, they went to acquiring companies with more niche purposes. Eventually, this forced them to do a major management overhaul between the months of August and December in 2020. At this point, the stock is still trading way below their initial IPO offering, and it looks like people who bought at IPO will be left back holding. The next example I have involves Chuck E. Cheese. Valuation-wise, this SPAC wasn't doing so bad compared to AVCT, but it did fail to merge. Chuck E. Cheese parent company CEC Entertainment merged with Apollo Global Management and Leo Holdings on April 8, 2019. The company we're interested in is Leo Holdings, as this is a pretty well-funded SPAC. This merger brought Chuck E. Cheese valuation to a whopping $1.4 billion. On the other hand, one of Leo Holdings' SPAC was worth $200 million at IPO. Did you notice I said only one of Leo Holdings? Lion Capital is the managing company of Leo Holdings, and they offered many SPACs. Currently, Lion Capital issued its fourth SPAC called Leo Holdings 4. On February 23rd, it IPO'd for around $300 million. As you can see, the SPAC is pretty well funded, and even after many rounds of failures, they continue to issue new rounds of SPAC. Anyways, Leo Holdings decided to merge with Chuck E. Cheese. Around this time, you probably noticed Chuck E. Cheese going through major updates. For instance, you saw the mouse change, and Leo Holdings pushed for a business model that was more efficient by digitalizing the services. This caused its Q1 earning of 2015 to be at 7.7%, when in only Q4 of 2014 it was only at 3.3%. However, this partnership was soon to end. On January 29, 2019, it was reported that Chuck E. Cheese will not be merging with Leo Holdings. It was not reported why the merger was called off, but this cancellation brought evaluations down for both parties. As shown, there are two ways you can lose money on SPACs. The first way is like AVCT, where you buy at IPO but they perform poorly and you backhold those shares forever. The second way is like Leo Holdings, where the SPAC does somewhat well at first but a merger fails and you lose your money off that. Therefore, SPACs are a very speculative trade, as SPACs in itself have no inherent value, as they only gain value based on which companies they decide to acquire. However, there are some successful SPACs out there. Live Oak Acquisition is a SPAC formed by Richard Hendricks and Gary Wunderlich, who are both respected in the field of investing. In Live Oak Acquisition 1, they IPO'd at $200 million in May of 2020. They decided to acquire Danimer Scientific, which is a producer of 100% biodegradable plastic. Danimer Scientific was trading at the $9 to $10 range. However, their stock was able to peak at around $66. That is a 593% gain in value. Currently, it is trading at around $42, but is still up 339% from May of 2020. Since then, Live Oak Acquisition has introduced two more SPACs. Live Oak Acquisition 2 had a $220 million IPO in December of 2020 and is still looking for businesses to acquire. On the other hand, Live Oak Mobility IPO'd in March 2021 and is focused on motion technology sectors. Whatever the case, you do see some SPACs that outperform the S&P 500 by a lot. With that, I'm going to end this video. If you liked this video and want to watch more videos like this, press the subscribe button. If you thought this video helped you in any way, like the video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all the questions. Thanks for tuning in, and I'll see everyone on Sunday. Thanks.